Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Kelsey Berro, she joins us today from JP Morgan Asset Management. Tariffs. Everybody's worried about substituting. I'm going to substitute for my overpriced tomatoes from Mexico. I would suggest, and I'm seeing it percolating, that far more here is the income effect of tariffs. Slowing economy, dampen wage growth, and that. What do bonds do, bills, notes, and bonds, given a slowing income effect, a dampened income effect?
Right. So, I mean, the data that we've been seeing suggests that the U.S. economy is moderating and maybe even slowing a little bit more aggressively than the term moderating. So if I look at real consumption spending over the first 6 months of the year, it's annualized negative for the first time since 2010.
Is that price up, yield down?
I would say so. I mean, I think that is the reaction in the bond market that you're seeing, which is that yields have been somewhat range bound this year. But when data does come in weaker than expected, like the payrolls report we got on Friday, you see an aggressive move lower in yields, and that's been a function of this low hire, low fire labor market, the way that we've been describing it, which is not necessarily that companies are laying people off, but they are having them work less hours, and they are holding off on investment plans until they get more certainty. And I think the question is, going forward, we do have a bit more clarity on the future outlook, right? We have the One Big Beautiful Bill Act. Yep. We also have some sense of tariffs, right? They're not going away. Maybe the average effective tariff rate is going to end up being around 15%, between 15 and 20%. Yeah, it's not great, but at least we know what it is. The question is, do you see a re-acceleration in some of this activity now that things are slightly more stable? Or is there actually more damage to come from the tariffs and we've been complacent because it's just a longer lag than people anticipated between higher costs and slower demand and the impact on the economy?
You're right. I mean, I think some of the earnings outlooks we've seen from some of these companies they're still cautiously optimistic, but I think that's kind of a win. I mean, because you don't really know what a 15 to 20% tariff is going to do to your balance sheet. So do we take credit risk out there? Are you guys sensing that it's time to take some credit risk, or taking credit risk is okay? Yeah, I mean, we have been taking credit risk. We have been stress testing all of the companies that we own, assessing how they would handle 10% tariffs, 20% tariffs. And the credit analysts have all come back to us and they've said, it's not great for earnings. It's not great for revenue. We're projecting a slowdown, but we're not projecting our earnings or revenue turn negative, and we're not projecting that this is necessarily going to cause a recession. And I will say at the same time, expectations have been lowered. And so when Q2 earnings have come out, it's been a clear beat. And now we're refocusing from the negative impacts of tariffs to the potential positive impacts associated with One Big Beautiful Bill. So a lot more companies are talking about upgrading free cash flow estimates because of expensing of R&D or interest deductibility or lower emission standards for auto companies. So, I mean, I guess one of the questions here is, how does that balance out? We got kind of maybe the dampening effects of tariffs, but maybe the pro-growth effects of some of this One Big Beautiful Bill that you mentioned. So net, as you look out to 2026, kind of how's the outlook out there for you guys?
Yeah, I mean, net, our base case has been sub-trend growth. And I think that our confidence around that sub-trend base case has grown because of a lot of these offsets. You have the tariffs, but you have the One Big Beautiful Bill. You also think about the concerns earlier in the year with the deficits, right? There was a lot of concerns about expanding deficits. Now we have the trajectory for debt growth based on the new tax legislation, but we also know that we have a lot of tariff revenue coming in. So what have we gotten in fixed income so far this year?
Stimulus.
Well, stimulus maybe, but it's a carry environment. So one where we started with high all-in yields within fixed income at the start of the year. And with yields range bound and spreads range bound, I look at returns year to date on the US Ag, 4.7%. That's essentially that carry environment that we were kind of expecting when we went into this year.
What's your 12-month forward view on IG paper then? Can you make 6-7% in fixed income?
It will obviously depend how much risk-free rates fall and how much spreads narrow from here. But even if we just stay range-bound, you can expect the 12-month forward return on your investment-grade portfolio to look similar to your starting yield.
I'm so glad I don't have a real job. With a real job, Kelsey Berro, GP.
He's got a real job.
This morning, I just the cross currents that my head's spinning, folks.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
John Stoltzfus. He's with Oppenheimer and Company. He is the one who said, do you have courage, stay in the market? In October, 2 times ago, 3 times ago, 4 times ago, April passed. Paul, I just framed it out. You can do this on the Bloomberg terminal. Thank you, Mr. Secunda. And it's simple. The Stoltzfus call from here is up 11.7% out 1 year. And that gets you out to 7,100. So I interpolated, that's all, we do that for John. I interpolated Dow 47,000 plus on that. It's a double-digit lift, but not too double-digity. You're 7,100. People think you're nuts. Explain why you're not nuts.
Well, thanks, Tom. And always great to be on Bloomberg Radio surveillance with you and Paul and Lisa. And just want to say that where we are, the fundamentals look good. You know, it's in spite of everything. It would appear that when you think about it, it's almost it's about 17, 18 years ago since the financial crisis, and corporations aided by technology significantly, as well as the Federal Reserve, the Ben Bernanke legacy, as we call it, have been able to manage a lot of situations, including so far this tariff regime. As it comes in.
But the bear people, the guys that say Stoltzfus is nuts, they're going to say, okay, it's great, but at some point it ends and we have a correction down 10%, a bear market down 18%, or a normal collapse down 35%. Where is that emotion out there?
Well, that's a good question. I think what it is that bearishness always exists. There's a lot of people who feel that the Fed has maintained rates too high, their benchmark rate too high for too long. On the other hand, when we look at it, what we say is they raised 11 times and they paused, I think, about 14 or 15 times now, and no recession. So remarkably sensitive to their dual mandate, which is essentially giving us what we would have to say is a economic growth at a sustainable pace without untoward levels of inflation, with also not disrupting the job market, although we're seeing jobs slow. But Tom, it just looks like it really is a mid-cycle extension by monetary policy that makes when you look at the economic cycle, it's as wide as the Amazon, not the outfit that delivers the boxes to your home, but rather the Amazon River. And this has been going on for quite a while.
And this is the underestimation of American productivity and American initiative.
And we saw a nice pickup there today. You've got AI that appears to be in what we would say is a watershed period in terms of technology.
He's too enthusiastic for this show.
Exactly. John, reading through your notes, something jumped out at me. Sometimes it seems to us that quite a few folks probably don't know what the best performing S&P 5 sector is year to date. I happen to know because I have a Bloomberg terminal in front of me.
Yeah.
Industrials.
Isn't that wild?
What does that tell you about this market?
Oh, what it tells us is that you've got a broadening in the rally, which we began to look at and expect last year in the fourth quarter, and even earlier than that. We were saying this rally's broadening. A lot of denial about that. Everyone, it's just Mag 7, and it's just so narrow. But you've got, if you look at it on a year-to-date, industrials is up 14.4%, outperforming the benchmark that's up 7, the underlying benchmark that's up 7.8. Communication services up 13.9, infotech up 13.78, And then utilities up 12.8. That's a defensive. After that, you got financials, really quite a bit of a value sector, 7.3. Materials, my gosh, up 5. It really, this is staples up 5%. Real estate limping along up 1.57. Energy's negative. Consumer discretionary is down nearly 2%. Healthcare is down 5%. But those are understandable, at least at this point, yet we think consumer discretionary is improving in performance considerably. I mean, you look at this, you also think, has this been a dramatic overbought kind of rally? And we will say, from the low of April 8th of this year, infotech is up over 50% as a sector. Communication services up 33.6, but industrials up 29.54, and consumer discretionary up 27. I won't belabor going through all of these, but my point is that looks wild. But then take it from the February 19th peak, and the S&P is only up 3.27%. Infotech's up 11 and change. Industrials up 8.7. Again, second best performing. Utilities, third best performing sector, up 6.8. So what we say is you're beginning to see this broadening in the rally. Small and mids are still pretty brutally treated on a given day when the traders are just taking some profits in large caps. If the news flow isn't worrying, they go into smalls and mids and bid them up a little bit. We think that requires the Fed cut. And we think that's more likely than not in September as a result of those jobs numbers. And Powell has talked about for a long time the importance of the dual mandate, and the sensitivity towards that dual mandate would tell us, probably about a 25 bips, maybe even a 50 bips cut.
What have you seen from corporate America in terms of earnings so far this quarter?
Oh gosh, well, when it comes to earnings, I was just looking at the EA page, and I think it's up nearly 12% earnings growth. You've got three sectors that are double-digit returns. That's off of the top of my head. That's tech, communication services, and financials. You've only got one negative, and I think that's a negative double-digit earnings growth. I think that's energy. And effectively, you've got 8 positive earnings growth, 3 negative. This is remarkably healthy, but we really think a lot of it has to do, like Jimi Hendrix used to say, are you experienced? Indeed, managements of corporations and the U.S. consumer are more experienced to dealing with waters that need attention to navigate. And have the tools through technology. Just think of the communications. I've been in this business since 1983, so I remember when there wasn't a Bloomberg, when there wasn't a Bloomberg News, there wasn't all these different. We have today. People know.
Let me reintroduce John Stoltzfus with us. He has an acclaimed bull market call. He has nailed what we've seen over the last number of years. He's with the venerable Oppenheimer and Company as chief investment strategist. You mentioned James Hendricks and all of this. Were we better off when we were in the office looking at the back section of the Wall Street Journal, and earnings was revenue, net income, shares, and when you went to get a cup of Sanka or Postum or Nescafe, you risked tripping over the value line on the floor? Were we better back then in terms of having the knowledge and conviction to stay in the market?
I don't think so. And in fact, the change that we have seen very much, especially amongst private investors, is private investors used to get into the bull market usually after it was up. This is just anecdotal recall, but probably 10 or 15%. Everybody's talking about it. If you don't own stocks when you go to the cocktail party.
Okay, but the bottom line is everybody's managing their own retirement account.
You got it.
And that's the sea change here.
I think that's what it is. It's serious investing by the private investor. It doesn't mean they still don't have plays that they do, whether it's the Mag 7 or God help us, the memes. But when you look at it, it adds support to this bull market in that you've got intermediate and long-term investors who are looking for the babies that get tossed out with the bathwater on pullbacks rather than buying dips blindly. And they're in it for the longer haul because multi-generations now, from the boomers all the way to the younger generations, have a realization that Social Security is not likely to give anywhere near the retirement percentage of income, and as it once did for their great-grandparents, their grandparents, and certainly for their and for their parents. And so people need to provide for themselves, and the market offers an opportunity.
John, Tom has his focus on the VIX, and right now it's pretty quiescent, around 16 times. But boy, this year's been anything but in the S&P 500, with a 20% decline there in April with the tariffs. But then, boy, nearly a 30% rebound off that low, all in 7 months. Yeah. We don't see that very often, do we?
No, and I think once again, I think that is the ability of the market to discount data that crosses the proverbial transom on any given day, whether it's economic data, whether it has to do with a report related to the management of a corporation or policy change or considerations of policy. All this stuff happens relatively fast. And if you look at the chart, it just looks like whenever the VIX gets too sleepy, you become vulnerable to see a bit of a spike somewhere along the line. But the reality is the spikes have been lower of late. The pattern, I'm not a technical strategist, I'm a fundamental strategist, but we look at the VIX because when it gets too sleepy, get ready, and then be prepared to, instead of running for the hills, based on the fundamentals, look for good quality stocks that get tossed up.
So what do you do with Mag 7 now? I'm in it. I own Mag 7. I don't want to sell it. What does John Stoltzfus say? I don't own them. Should I? I mean, what do you do with Mag 7 for the flavors of regret out there now?
Well, we do say we think you do need to own them because we think they are an intermediate to longer term story because of the deeply embedded nature of technology in the lives of both consumers and business. And but it also means if you look at just our little box that we put every week in our piece, where you look at the S&P 500, we don't rate our sectors either overweight or underweight, but we rate them outperform, market perform, or below or underperform rather. And when we look at technology itself, what we say on Infotech, it's about 30% weighting, I think, in the benchmark. So we say 25% as a conversation point for an advisor and their client. They may want much less. They may have more. It depends upon their tolerance to risk.
One thing, you mentioned the economist James Hendricks.
Yes.
Okay. I don't think people know his history, that this guy came up with foundational blues. I mean, everybody knows Woodstock and all that, but he came up foundational blues. Literally, he was the opening band as a kid for the Isley Brothers a million years ago. I mean, the blues foundation was something.
Oh, it's spectacular. And when you consider not only his lead guitar playing, but the comping was fabulous.
Was original.
I mean, he was like very, very central to what would be the Memphis kind of sound. He was part of that. I mean, the cross, whether you consider James Burton or Jimi Hendrix, the comping, just fabulous.
It's great.
All right.
Is that enough guitar talk for today?
That's plenty.
John will come back. John Stoltzfus, thank you so much. Congratulations on really one of the great calls. I pull it in with Ralph Ancampora. Ed Yardeni has been brilliant on a bull market. Belsky's been okay. I mean, I don't,
No, he's...
he likes the Vikings. Well, it's an asterisk, but okay, he's been okay. And John Stoltzfus has killed it at Opco as well.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This is the conversation of the day for people worried about transatlantic confidence. Mark Dowding is with Blue Bay Asset Management. In the heart of COVID, they did an agreement with the Royal Bank of Canada. It is RBC Blue Bay Asset Management. He has been a student of our greater opinion, our economics, our finance, our investment around credit for decades. Mark, what's the level of confidence in the city this morning that we can get beyond this tariff Thursday? What's the confidence level forward?
So I'd say that we're actually in a reasonable position at the moment stateside when we look towards the coming year in 2026. I think in this respect, there's a real sense that into the year ahead, we're probably going to see lower taxes, lower rates, less regulation, and that speaks to a better outcome for the coming year. Albeit in the short term, we think that in the short term there could be some softness in data, as we saw with the payrolls numbers last week, as some of these sort of tariffs and the past uncertainty impacts the data in the second half of the year. So short term, I'd say things look a bit bumpy. Further out, it looks a lot better. But by and large, I'd say that markets are looking pretty cheerful right now.
And Paul, to the observation you had, that all of a sudden August has a certain pace to it for New York M&A.
Sure, and we're starting to see some animal spirits a little bit, and also in the IPO market. So, Mark, as you think about it, how are you surprised that despite all the tariff headwinds, crosswinds, I'm not sure kind of where they are depending on what country you are, that markets are performing relatively well here, certainly with the stock markets hitting all-time highs here?
Yeah, well, I think in terms of the US stock market, it comes back to earnings, and earnings growth has been solid, hasn't it? I mean, it's looking pretty good, and from that perspective, it also feels like all through the year, the stock market has been climbing a wall of worry. I think some of the fears that were being expressed back in April have really melted into the background, and having got the budget done, having got the tariffs through, without a big sort of pushback in a retaliatory sense, effectively what the US has done here is it's effectively managed to raise taxes pretty materially. We think that the tax take on revenues from tariffs will about 450 billion, which is up 370 billion year over year. That's around 1.2% of GDP. So this has been a decent outcome for the US. And so in many respects, I don't think it should be a big surprise that US stocks have been performing reasonably well.
I can see you in your ute, Mark, in a class with Skidelsky at Warwick. I can just see it right now. What does this do to the income generation of our trade allies? I mean, do we see slowness in Europe, the United Kingdom, in Asia off of these trade agreements?
So ostensibly, yes, we should see a bit of I mean, in as much as the US is having a win here, it's relatively speaking a trade war loss for other countries elsewhere in the world. I think the big question, though, and this is the big question that the Fed is also asking, is that if you've raised tariffs by 1.2% of GDP, who's footing the bill? Is it going to be US consumers, or is it going to be overseas producers? And the mix of that, I think, is really going to determine where markets go in the months ahead.
We're going to continue here with Mark Dowding, RBC Blue Bay. Thrilled he could be with us today with just wonderful transatlantic perspective. We're going to get perspective on economics right now. A productivity series coming out, unit labor costs has my attention. And also we see claims at 222 is a survey, 222,000. Of course, a revision will be important, made more important by the jobs report that we saw today. Further data at 10 o'clock this morning. Let's go to it. The economic data coming out right now. We use ECO Go, which is a good thing to do. Unit labor costs come in a tick higher than the survey. 1.5% is 1.6%. Non-farm productivity shows a productive America. 2% statistic comes in at 2.4%. Revisions on claims flat. In a more difficult claims, slightly, ever so slightly, 222 comes in with a 226 claims as well. I don't see a lot of meat there for anybody, Paul.
No, I don't.
Right
I mean, the initial jobless claims a little bit higher than expectations, and a little bit of a revision higher last time. We'll keep an eye on that. Continuing claims, a little bit higher than expectations, but we had a revision downward last month. So there you go.
Surveillance data check audible. Gold up $25, 3458 is $60 to a record high on gold. I have no idea what that has to do with economics. Commonwealth going, Tom, why are you doing gold during our economics? Commonwealth, we thank them for all of Bloomberg's surveillance. Bloomberg surveillance this morning brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor to staff ratio, small firm attentiveness, big advisor impact. Go to commonwealth.com. commonwealth.com to learn about their consultative support and technology. Paul, why don't you bring in Mr. Dowding inland?
Sure, absolutely. Mark Dowding stays with the CIO of RBC Blue Bay Asset Management. Hey, Mark, the Bank of England cut interest rates to the lowest level today in over 2 years. What do you make of that? And how do you think that may or may not influence the U.S. Federal Reserve?
So I think the picture in the UK is rather different to that in the US. The economy here is rather limping along. We've really been sort of struggling for a few years in economic terms. And it's interesting just hearing that sort of productivity data that we hear in the US. Productivity at 2.4, because we see strong investment in the US, because we see those productivity gains in technology. By contrast, in the UK, we have next to no productivity growth whatsoever. So that's why UK rates are coming down, because the economy is slow. At the same time, here in the UK, actually our worry is that inflation is too high. I think in the US, it's a very different situation. We've actually got an economy that has been very healthy for an extended period of time. It's more a question of whether the Fed can ease rates, because the economy could go faster than it currently is if there isn't any inflation to worry about.
Mark, when you were at Warwick, and I don't know if you served under Skidelsky in Warwick Economics, did you actually read the 1,021 pages of Skidelsky, John Maynard Keynes?
Oh, hell no. I mean, I wasn't that good of a student, right? Kudos to anyone who did, who made it through all of that. I think back in the days when I had hair on my head, I was probably too interested in the parties more than the lectures. But it certainly gave me a good grounding, that pace. It's a fine institution.
Mark Dowding, thank you so much. I bring that up, folks. Lord Skidelsky was just hugely supportive of the advent of all of this. And we thank him and University of Warwick for their support in our early years. Mark Dowding, RBC Blue Bay Capital.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Joining us now, foundational. We had Stoltzfus in. It's sort of the same thing as John Stoltzfus. Joe Carson has pretty much seen it all. He's a former chief economist, Alliance Bernstein, publisher of the Carson Report. Joe, are you retired? You're not retired, are you?
Semi-retired.
He's only working 70 hours a week. He's cut it back from 80. Joe, let's do this with you. You're the first one I've talked to. I got an inflation report next week. Okay, I got a labor economy struggling. The consensus is inflation, as I think you called, is persistent. Which is more important, the inflation report next week or the next claims number on labor?
Well, they're both connected in some ways. Certainly, the tariff-related impact on goods prices is starting to come through, and it'll come through even more over the next several months. It takes time to show up on the shelves and what people pay and what companies pay. But I think the labor data that you've seen recently, particularly the small job gains, is a reflection that companies are having a hard time to plan how to operate in this environment where tariffs go in and out or up and down, and they're not knowing where they're going to go next.
So putting it all together here, I mean, Tom likes to talk about the resilience of the U.S. consumer, the resilience of companies in general. Are these tariffs something that we all can kind of deal with and get through and get past without seeing any significant economic slowdown or pickup in inflation?
Well, that's very unlikely. I think you've already seen a significant slowdown in hiring. That means companies are not investing or planning to grow their companies because they increase costs. One thing that's being missed is that in the first 9 months of this fiscal year, corporate tax collections were off $30 billion from a year ago based on higher expenses. And that's tied to the tariffs. The inflation rate will pick up, and that's going to hurt consumer spending and make consumers more cautious on what they do. So it's not a zero-sum game. And when you raise tariffs, it's like putting a tax on the consumer and businesses. And also keep in mind the initial intent of tariffs was to bring back manufacturing or increase manufacturing relative to where it was before. But the problem is that many of our companies operate on a global basis, not with a national footprint. So putting cost increases on a lot of materials and supply raises the cost of production for them and makes them uncompetitive in the world. So it's a really odd policy, and I think it's going to have bad consequences down the road.
We had some weak labor data last week, and then we had the Bureau of Labor Statistics commissioner effectively fired by the president. What did you make of all that noise last week?
Well, let me say three things on this. The politics around labor market data or economic data has been around a long time. Presidents have always complained about the interpretation of data, but never the actual data itself. Okay, so that's one thing. Second, the fact that the Treasury Secretary, Bessent, and the National Economic Council Director, Hassett, did not defend the BLS in this is shocking, okay? I've never seen that before in my long career. And the third point is what the administration was able to do is flip the switch here. How many reports have been on the firing of the BLS commissioner, and how many reports on what the actual data says? They don't want you to talk about the data because the data shows labor markets are struggling and companies are struggling. That was the message there, but it's been blunted. So the financial press, you guys in particular, have a big job to tell the truth going forward.
Joe, thank you so much. Joe Carson with us, formerly with Alliance Bernstein there, and the comments on Mr. Hassett are clearly out in the zeitgeist. We'll be addressing that in the coming days here.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Right now to the newspapers. Lisa Mateo.
Okay, I want to start with the New York Times because sources are saying that President Trump weighing getting involved in the New York City mayor's race to help try and stop Zohran Mamdani. So what he's reportedly done, this is according to the Times, who spoke to people, they said he's picked the brain of a Republican congressman, New York businessman about the crowded field, right? Who has the best chance of beating Mamdani? He also was briefed by Mark Penn. He's a pollster who worked with Alexa, Bill, and Hillary Clinton, right? He also Andrew Stein, a former New York City council president, a range of polling that's showing that actually former Governor Cuomo could still be a competitive factor as an independent. So what the article does, it really raises questions about what the president's involvement in the race would do, saying it could bring like this new element of unpredictability to something that's already so wild and crazy.
In a conversation with Governor Cuomo in the last 72 hours, he established the timeline, and he was heated that nothing happens till after Labor Day. Everybody now is jockeying positioning. It's going to be fascinating. I'll make it up, Paul, the second week of September, when this thing really heats up. This gets
serious, and we kind of keep hearing that either Mayor Adams or former Governor Cuomo, somebody needs to maybe bow out, so coalesce the Democratic Party around that remaining candidate. So we'll see how that plays out.
What do you got next?
Okay, this is kind of thinking about what's in your cupboards, what's in your refrigerator, what's in all that stuff.
Captain Crunch this morning.
No, see, that's the problem. So this is according to the CDC's nutrition survey. 62% of childhood diets come from highly processed foods. So we're talking about burgers, pastries, snacks, pizza, thing like that. Nice. For adults, it was 53%, not as much, but still high. It's still a dip, though, from about 5 years ago when the survey was taken. But what they're saying is that how you can avoid these highly processed food is you go to the store and you look at the label. If there are ingredients there that are not in your kitchen, then it's probably highly processed. This is what I do when I go to the supermarket. Yes,
you do that.
I know people hate me in the supermarket because I'm the one who's
people
crowding
might
the
hate you at
aisle.
home. I mean, people are like, "Oh, Mom brought home some more." Like, are we supposed to eat this stuff, kind of thing?
But some of the so what are some of like the top ultra processed foods you don't think of? Sandwiches, actually. I love cold cuts. Followed by sweet baked goods, savory snacks. Those were some of the high things. But it's it's a series because doctors link those ultra processed
Everything
foods,
in moderation.
diabetes and
That's
stuff.
my whole thing for
right,
life.
and weight gain. So that's the story of
Are
this
you
study
done?
coming out. No, this next one's a good one. Okay, college kids, they love their Google Calendar, right? They call it GCal. That's slang for it, okay? So they're using it to schedule everything, like what time to go to sleep, what time they eat, if they want to go for a walk. But what they're also scheduling it to do is asking someone on a date. That's actually a new thing. Hooking up. You send someone a Google Calendar invite. That's the way the kids are doing it nowadays.
Really?
Who knew? I mean, they're sending screenshots of their entire calendar, color coded and everything. And they're saying, well, if you can fit into my schedule, then maybe we can make something work.
Again, just go to a bar. That's how you do it, kids.
But I mean,
That's a voice of experience.
Exactly.
I believe.
It's kind of impressive how organized they are in that way. But
all right.
it's a bit much.
Slip one more in here quickly. One more
Okay,
quick.
Top Golf Callaway brands, they came out with earnings, right? It was an earnings beat. You know what was a big thing for them? The big thing was their promotions. They had frozen margaritas and half off golf during the week.
Nice.
So half price golf during the week. People love that. They come out, they have a margarita, they're happy.
Yeah, I
It's
heard
working
a good
for
time.
them.
I mean, I've not been, but I've heard great things about it.
Top Golf, I love it.
Yeah,
it's a fun. Yeah,
Have you done
it's a fun.
it?
I
Okay,
have. It's
right.
very fun. You
Just
order
camping,
food, you order
just Top
drinks.
Golf.
Does
bring
it
a bunch
make
of
you
people.
better, like if you're like Sassower and you need help?
Don't know. I'm not a
I
golfer.
mean, Damien needs help. Could you see
Yes.
Damien at Top Golf?
Oh, yeah. Driving them nuts.
Oh, but it's a fun time.
Thank you, Elisa Mateo. Thank you so much for the newspapers. Greatly appreciate it.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.